Hello and welcome back to Game of Trades, your number one channel for videos on the stock market and cryptocurrencies. This chart right here has been one of the most useful indicators to time tops and bottoms throughout the last 20 years. Now, this is a chart of the utilities sector against the S&P 500, so it shows you the relative performance of utilities stocks against the broader market. Now you can see this is the outperformance we saw during the 2001 bear market. This is the outperformance we saw during the global financial crisis. Now since 2009, and this is something that we've discussed before on this channel, since 2009, we've seen the utility sector trend in this bearish channel, so underperforming the S&P 500. But what's been fascinating about this is that this channel has timed some of the most important market tops as it tests the bottom of the channel and market bottoms as this ratio tests the top of this price channel. It has done so again and again in 2018, timing the bottom of this market correction, in 2020, timing the bottom of the COVID bear market. And more recently, we saw the utility sector tag the top of this price channel here, marking at that exact moment the low we saw in October of 2020. Now the ratio seems to be turning back up again, and momentum also turning back up, flipping back into bullish territory. So in this video, we are going to be diving into how we can use the utilities sector not only to time the S&P 500, but also outperform, and more importantly, what it's telling us about the market today. Is this the end of this secular underperformance we've seen on utilities as we see momentum on XLU flip back into bullish territory, potentially breaking out of this downtrend? That's exactly what we're going to be taking a look at today. If you enjoy this video, don't forget to hit that like button. It helps us out massively. It makes a huge difference to the channel. Now, without further ado, let's get right into it. Now, first of all, these stocks the utility sector provides are companies that provide services such as electric power, natural gas, water supply, sewage removal. So a lot of very essential services for the economy that are actually a lot more stable than other stocks that are very sensitive to the economic cycle. Stocks like industrials or consumer discretionary are very sensitive to changes in consumer spending, changes in the labor market. Whereas utilities, well, everybody needs water, everybody needs electricity, so the earnings of those stocks typically don't get affected that much during times of economic turmoil like 2008 and like 1999. So this is why these stocks are very often seen as defensive stocks as opposed to aggressive risk-on stocks. And the proof of that is in this correlation coefficient. You can see if we look at what the correlation of this ratio is to the performance of the S&P 500, the majority of the time it's negative. Now that may sound obvious, but it's really not. Not all sector ratio charts have a negative correlation to the S&P 500. Stocks like consumer discretionary and transportation stocks, technology stocks, well, those ratios actually tend to have a positive correlation, meaning when the S&P 500 goes down, those stocks go down even more. And when the S&P 500 goes up, those stocks go up even more. Now, utilities, you can see when you have an S&P 500 correction, well, utilities tend to be very resilient. Again, here in 2011, very resilient. Of course, in 2008, very resilient during the global financial crisis. Now, of course, the catch is that, on the other hand, when the S&P 500 is going up, well, look at how utilities perform. Well, they clearly underperform the market. Right, that was the case here in 2012, 2013, between 2016 to 2017. And of course, let's not forget 2020 to 2021, big underperformance of utility stocks, but they've regained some of that ground in 2022. Now, what's interesting about this is that it gives you an additional insight into what the whole market is thinking about today's macro environment. So, and that's from a macro standpoint and also from a technical standpoint. So the fact that in each of these cases, the channel that has been respected since really 2011, the fact that it was not broken in 2016 told you that market participants were not pessimistic enough to fly to safety and bid up XLU and begin outperforming, right? From a technical standpoint, this is a rejection, and this is the market telling you we're not heading into a recession. Things are actually pretty good and earnings are going to hold up. And although earnings have been weak over the past year, right, 2015, 2016, that's probably not going to continue in the future, or else you would have seen a breakout above this channel, right? Same thing during COVID here, right? If we were really heading into a collapse of the financial system because of COVID, and you were going to see the entire stock market completely collapse because of a massive recession, well, you would have seen this ratio really break out and show conviction. But no, look at what happened. This market, XLU to the SP 500, told you that earnings were actually going to hold up pretty well here because it rejected, because XLU started to underperform the market back in April of 2020, as market participants started to really get aggressive on the stock market, expecting that came into the market during the pandemic would fuel a big economic boom. And you had that earnings boom that really fueled the market a lot higher. Now, you had the exact same thing happen again here in September of 2022. A big fat rejection here off this channel. This was basically the equivalent of the utility sector telling you, okay, there's not a recession that's happening right now. Earnings are not heading down, and XLU doesn't need to break out here and get bid up. But now potentially you can see momentum is turning back up again. You can see here weekly momentum just crossed bullish again. This is really, from a pure objective technical standpoint, this is not something that's very encouraging for the bullish case. So is this the moment to be concerned that we are indeed heading into a recession? By the way, don't forget to hit the like button if you're so far enjoying this video. If this is the type of video that you like, I don't think there is much education out there on these topics, but if you find it valuable, don't hesitate to let us know. It does make a huge difference. So now let's take a look at the tea leaves a little bit, look at some potential patterns that are developing on this chart to try and understand what it's telling us right now. And the first thing I want to highlight is this potential head and shoulder bottoming pattern on XLU. Now, these patterns, head and shoulder patterns, can pinpoint when a major reversal is happening, right? And one example of that you can see on this chart is this massive head and shoulder pattern that you had developed between 2005 and 2012 with a clean shoulder here, a head here, and another shoulder here. These patterns work really well when you have these types of parabolic moves because it's telling you that the price action is getting really overextended. Now, how these patterns typically work is you have a measured target that is equivalent to the height of the head. You can see here around 33%. That took you around all the way down to the levels we saw in 2021. Now, of course, as I said, they are to be taken with a grain of salt. You can see you had a very similar pattern develop right there between 2016 and 2020, and another shoulder right here. And that did not play out. Utilities rejected off the price channel here and started to trend down after COVID, as we just discussed. Now, you could argue that we were indeed heading into a recession before COVID happened. We had just seen the yield curve invert for the first time since 2007, and the economy was showing signs back here that it was weakening quite rapidly with consumer spending and the labor market weakening. Of course, you had the exogenous shock from the COVID stimulus. Of course, you had COVID that stepped in right here, a massive amount of stimulus that potentially pushed out the recession that was supposed to come in 2020, 2021. This is something that we've discussed many times before, that the massive response following the pandemic really disturbed the entire economic cycle. And instead we saw a massive boom that first of all got kickstarted by big tech outperforming during the pandemic, and then a big earnings boom as people started to spend during the reopening. Now, could the same thing happen again today? It's unlikely that we see this massive unexpected stimulus from the Fed. That's extremely unlikely given the high inflation rate. Is it possible that potentially that a Fed pivot could create some optimism? That's very possible. We saw that in December of 2018 here. This big rejection you can see here, that was the day that the Fed really started to change their tone regarding monetary policy, these patterns really don't mean anything until they've broken out. So from a pure technical standpoint, this chart remains very much at resistance and could be vulnerable to moving down again, just like it did in 2016, in 2011, in 2020, 2019. But if it does break out, you can see the measured target here is around a 38.5% outperformance from the break of the trend line. So not from current levels, but from this level here. And that could theoretically take this ratio back up to the levels that we had during the 2008 financial crisis. Now, if that does happen, if we do see a breakout above this price channel, that's an ominous sign for the stock market. It's something that we're monitoring. It's something that we're looking at very carefully, because if that does happen, it does suggest that we are indeed seeing the end of the secular bull run that we've seen that has been characterized by this underperformance in XLU relative to the SP 500. Now again, that hasn't happened yet, but this will be one of the topics of our research over the next few weeks and months at gameoftrades.net. We'll be assessing how different sectors, including utilities, how they perform when inflation is coming down, as we've seen over the past few months, and we're likely going to continue seeing over the next few months, but also how these sectors typically perform after a yield curve inversion that typically predicts a recession 1 to 2 years out ahead after the inversion that we've seen this year. And depending on the results of that quantitative work, and if we do find that this sector is an attractive bet and a hedge against downside on the stock market, we could be adding that to the model portfolio we have. By the way, don't forget to grab yourself the free trial on our website. We give all the research that backs up the allocation we have on our portfolio. We put out videos and lightning reports to walk you through very quickly through the key trades and setups that we have on the website. Now, that's about all I wanted to cover in this episode. I hope you guys enjoyed. If you did, again, don't forget to hit the like button. And now, in the meantime, I wish you good luck on your trading and see you next time.